Well, howdy there, folks. Welcome into today's reaction video. 4 things for me to react to. First one up here is Elon Musk talking about GM and Ford are going to go bankrupt in the fast lane. I want to kind of give my opinion and perspective in regards to that. Then I want to react to this video here. This gentleman's calling for a 2024 recession, so I want to hear what he has to say and react to that one. And then the last 2 videos are all going to be focused on Neil Kashkari, who's the scariest man in the financial world right now. And the reason is Neil Kashkari is running around everywhere. And I guess he was on CNBC a few hours ago and basically saying the Fed needs to go higher with rates. He's talking about there's a chance of substantially higher rates. And this man is scaring the living crap out of the stock market right now because people are just like, what? Is he serious? Like, is the Fed really going to go a lot higher? And so, yeah, we'll get into that one. I appreciate everybody joining me as always. Thank you so much for being here, folks. Thank you for being subscribed. New all-time high subscribers. I appreciate each and every one of you for being here. So, last night, Zero Hedge says Biden says he agrees with UAW, the United Auto Workers Union, basically should see a 40% increase in pay, right? And so Elon Musk responds to that. He says they want a 40% pay raise in a 32-hour work week, sure way to drive GM and Ford and Chrysler in bankrupt in the fast lane, right? And so there was Elon certainly didn't have to make that comment, right? But he made the comment. And so that definitely kind of shows that Elon's of the belief that those guys are going to go bankrupt in the fast lane in this situation, especially if, the United Auto Workers Union gets what they want here, right? And so what's my opinion on that? I think, those companies are just in a brutal situation no matter what. They're trying to transition their businesses to electric vehicles. They're trying to transition to self-driving vehicles. That's something that's going to play out over this next 5-10 years in a massive way, and they need to fully transition. By the end of this decade, you need to have your vehicles be able to drive themselves, and you need to be fully electric by the end of this decade. Those are 2 very extremely hard things to accomplish in themselves, right? Almost all those companies already have massive debt loads that they're carrying around in a higher interest rate environment, which is not great. Higher interest rate environment is also not great for demand simultaneously. And now if you're talking about a substantial pay increase, you just can't deal with that. So like I said, in regards to these companies, if they want any chance of survival, they got to transition to EVs, self-driving vehicles, and they're going to have to likely end up over the coming years, transition a lot of their production down to Mexico. That's what will end up happening in the end. So we'll see, but I do agree with Elon that, this whole situation is going to fast track those companies into bankrupt. Will I be shorting the stocks? No, it's not worth my time, okay? All right, next one up here. Fourth quarter will be a litmus test for my 2024 recession call.
David, I really wanted to talk to you because I was just curious if you were maintaining the bearish recession call as it has just not materialized.
It hasn't materialized, yet. It's, I'm talking to you here from Toronto, and it's as if it doesn't snow in December, then we'll just call off winter. There are lags that we all know, long and variable policy lags. And the reality is that when you look historically, from the time of the first rate hike by the Fed to the time the recession starts, is typically 2 years. So I think that maybe the people that were...
Boom. That's exactly what I talk about Fed lags. Fed lags catch up to you usually 1 to 3 years after you start raising rates, right? So 2023 is obviously year 1. Next year is year 2, right? 2024.
The gun calling for recession this year, we're just basically a little too impatient. Reminds me of the recession calls I was making in 2007. That was a very long, soft landing. But the recession started December of 2007. So I think we just have to basically acknowledge that this year the economy did better than expected for 2 reasons, Sarah. We had the lingering impact of the fiscal stimulus, and we had a consumer credit card boom. Those are not recurring. So it's going to be interesting to see, with the credit card issuance coming down and fiscal tailwinds moving to headwinds, how the consumer is going to be responding starting in the 4th quarter. So the 4th quarter is going to be a litmus test for my call, absolutely.
I'm not sure if the fiscal stimulus, though, reverses. I know what you mean on the consumer side and the excess savings coming down.
I like Sarah Eisen. She's always on top of her game for the most part. Like, she's been on CNBC for years, and she's usually on top of her game.
But we're also ramping up on infrastructure spending and the CHIPS Act and the Inflation Reduction Act. And some folks, one of the prevailing views here is that all of that money is going to come in next year and offset a potential recession.
No, I don't think that's going to happen. I think that when you're taking a look at the fiscal deficit, the GDP ratio, the big stimulus was actually this year. The incremental impact on growth was this year, not next year. And I don't know why you would be comparing industrial subsidies in the business, which is a relatively small share of GDP, to the impact of the consumer sector, which is 70% of GDP. You can't compare the two. The key is not how the CHIPS Act or all these other industrial subsidies, government intervention is going to influence the business cycle. The key.
So that's a great point this gentleman brings up here, but I think the one point he's missing there that I would push back on him with, right, is let's say you have weakness in some of the consumer sector. So I don't know, the guy that works at the restaurant can't get his hours, so he needs to find something else to do. So he goes and works in construction or something in some sort of industry where the government basically needs workers there, right? Well, there's that opportunity out there when you have all that spending on infrastructure and all these things, right? And so that's just something I think about, right? Let's say housing slows down in terms of home building, and all of a sudden there's not as many workers needed for home building. Well, some of those folks can go and work in the construction industry then at that point in time. So I don't know. Those are just things to kind of consider here. There's definitely some sort of offset there. Does it offset everything? I don't know about that. But there's at least some sort of offset that you have to at least acknowledge.
It's going to be what happens to the consumer now that these fiscal training wheels are off. We just don't know, Sarah, how is the consumer going to respond, not just to the impact of energy prices. I don't look at this as something permanent, but the lagged impact of the rate hikes, I think, are being underestimated by the Fed and by most of the people you interview from Wall Street. And I think that the shift from fiscal tailwinds to headwinds for the consumer, which is 70% of GDP, Sarah, what you're focusing on in the business sector is a small share of GDP. It's a small contribution, but I think the overwhelming impact is going to be the pullback that we'll see in the consumer sector over the course of the next several months.
That said, David, we're still having conversations about real hourly wages inflecting positive, disposable income on the rise. The share of disposable income that goes to gasoline is really kind of moderate. We had Rich Bernstein on yesterday talking about the pain trade being about a reacceleration in macro debt. I wonder what kind of debate you and he would be having if you were back in your old chairs.
Well, where's the reacceleration? We just got housing starts for the month of August. They were down 11%. We got new home sales. What was that? Yesterday, down 9%. Existing home sales were down. In inflation-adjusted terms, in August, retail sales were down. Actually, in August, real disposable income was down. So I'm not getting that sign of economic reacceleration unless your only metric is the Atlanta Fed's nowcast model. Everything else is showing that the economy is actually trudging along somewhere close to a 2% annual rate. But don't forget, we've been breathing fumes of the lingering impact of the fiscal stimulus all year long. That's coming to an end right now. So I don't know where the reacceleration is coming from, unless you believe somehow that interest rates don't matter.
It's just
and if you believe that policy lags don't.
So I definitely agree with that, gentleman. And I think something very telling was, did you guys see the Costco earnings last night that Costco reported? What I noticed in the Costco earnings, obviously Costco's a beast. They're always going to put up good numbers. It's one of the best companies literally in the world, right? And certainly one of the best stocks to invest in the past several decades. So Costco's always going to put up their numbers. But what I noticed that was kind of scary was their U.S. comp store sales were among the weakest I've seen for Costco in a long time. And the deceleration of comp store sales growth, if you look at their U.S. numbers, the U.S. numbers didn't even keep up with CPI. You heard me right. Their Costco comp store sales numbers did not even keep up with CPI, which is a little worrisome. This is freaking Costco we're talking about. So there's certainly starting to be a consumer slowdown of some kind. No one knows how soft things will get or it won't get, but there's no doubt the Fed lags are starting, early stages of starting to catch up here. And they could definitely catch up a lot more in 2024. And so overall, I got to say, I got to agree with that gentleman quite a bit in regards to what he just said there, right? Which, does that mean I'm going to not buy stocks? Of course not. I'm going to continue to load up on great companies, because you got to understand, these stocks that are at 5-year, 10-year, 15-year lows right now, which there's a long list of them, they're already pricing in what's coming. And that's something you got to get ahead of that. You got to get 6 to 12. The market's playing 6 to 12 months in the future. And so when you start to get a lot of the bad economic data that is like reassuring that, oh yeah, the consumer got hit bad and, recession's here or whatever, right? By that time, the market's already bottoming. Fed's already reversing by that point in time, right? Oh crap, we went too far. Look at this. We got jobs being lost, blah, blah, blah. So something to keep in mind. All right, let's listen to the scariest man in the stock market right now, Neil Kashkari. He is the Michael Myers of the stock market right now. Let's be very clear about that.
This year, keep policy tighter, longer, if the economy is stronger than expected. Neil Kashkari joins us this morning, along with our own Steve Leisman. I can handle one more. You guys were doing 75. You did 3 or 4 of those, so another 25 I can handle. What I love about the Fed is that you can institutionalize words. You remember conundrum? No one used it until the Fed started. Then there was significant, or was it substantial? And then if you say substantial versus significant, that makes a difference. Now there's 2 I want to talk to you about. What's a lag? And can you define it? And can you tell me how long it takes for it to happen? And the other is restrictive, because that's what I'm focused on right now.
Yeah. I've been talking to you guys about Fed lags for months now, man. Now all of a sudden everybody cares about Fed lags. Oh, this is interesting.
Are we restrictive right now?
Sufficiently restrictive. That's
another good one. Are we
sufficiently restrictive?
Are we sufficiently restrictive right now or not?
I don't know.
Right.
Very unsatisfying. I know, very unsatisfying, but you're asking the most important question. So,
oh, gosh, man, that's so scary. That's so scary in itself. One thing is, if you want to run around, do these interviews in oh, we could go substantially higher, blah, blah, blah. That's one thing. But that might even be more scary, what he just said. I don't know. Like that's one of those moments where you're just like, do you have any confidence? Do you have any confidence in what you guys are doing? Do you have any clue what you guys are doing? Because that's not reassuring. That's like, your quarterback going on the field and being like, are we going to go down and score a touchdown? And he's like, I don't know. Like, we need a little more confidence in that, kid. Like, come on, man. So, that's if you're dealing with kids and playing quarterback. Well, when you're dealing with something much more serious like the Federal Reserve and these gentlemen that are, obviously supposed to be experts at this stuff, you need some damn confidence. Go out there and say, we think we are very close or something. Don't just say, I don't know. That just projects like you don't have a clue what you're doing. It just projects bad, man.
The definition of restrictive in my mind is where are long-term real rates relative to the long-term neutral rate. And we can't observe the neutral rate. We can kind of estimate it. I thought before the pandemic, the neutral rate was around 0% real. We're at plus 200 basis points relative to that now. But it's possible, given the dynamics of the reopening of the economy, that the neutral rate may have moved up. So one thing that makes me cautious that we might not be as restrictive as we think is that consumer spending has remained robust. GDP growth continues to outperform, and the 2 sectors of the economy that are traditionally most sensitive to interest rate hikes, autos and housing, have both indicated some signs of bottoming and in some cases are starting to show some recovery. That makes me cautious that we might not be as restrictive as we otherwise would think.
But on the other hand...
what is he talking about? The real estate market's in a disaster, so I don't know what he's talking about there. Like, we're at numbers right now that you would have seen back in the great financial crisis. So the real estate market's in complete shambles right now. Where's he want it to go to? Like, worse than the great financial crisis? Like, is that what you want? Neil Kashkari? The auto market, if the auto market is so strong, why does Tesla keep cutting prices 1,000,000 times? Come on, man. And they're the ones that have by far and away the most demand of any automaker in the world. If the auto market was really already bottomed, then Tesla would be raising price again. They're not.
Ford, referencing John Ford. On the other hand, since we don't know about lags and how long they take, when I cook a steak on the grill, I put it in tinfoil because when it comes off the grill, it may not be, you leave it there for 5 minutes, it cooks more.
Yeah.
It cooks more. And you overcook it if you just, maybe we're already
Steak lags and monetary policy.
Maybe we're too.
I like that, Joe.
Isn't it possible that it's getting more restrictive day by day without you doing anything?
It is possible. That's correct. And that's why we have slowed the pace of our hikes. As you said, we did 4 75 basis point hikes. Then we did took a gap, we did 25, we took a gap, we did 25. We didn't do anything this past week. So we are allowing the data to come to us to try to figure out how much effect are we having in the economy and whether or not we need to do more. So we agree with that. And as inflation continues to come down, and we've made a lot of progress, I hope it continues, if policy stays where it is, real rates get tighter. So that's another factor.
What if oil stays where it is? Joe did all the highfalutin questions, which I normally do.
I'm done. I'm exhausted.
What about high oil prices? Is that something that you think inures to higher rates?
Not by itself. I mean, it can have an effect on consumer spending because it crowds out other things that households have to buy. But as you know, we look at core inflation because energy prices tend to move around a lot. And so I wouldn't look at energy price moves and say that's definitive on what inflation is going to do. But it is something that affects the economy.
Neil, just getting back to the places where you're seeing rises again, energy prices being one, housing being another. I mean, those are supply issues that you don't have any control over. So you can raise.
Yeah, if we are going to have a recession in 24, a consumer-led recession in a major way, I could tell you, whew, man, the crude folks are going to get slaughtered.
Rates to infinity, and you might not be able to fix.
But don't. Right.
But those are, I mean, it's a pretty blunt tool to try and fix those issues with higher rates.
I understand. Monetary policy is absolutely a blunt tool. But when we've seen such high inflation as we had over the past few years, we have a job to do, get inflation down to 2%. We've made a lot of progress. I feel very good about that. We need to finish the job. And whether we have to go higher from here, we'll see what the data tells us.
What is the prevailing view in the room about all of these strikes and the union efforts and the increases in wages across the country, and what you can and can't do about it, and what you should or shouldn't do about it, and what it means immediately for inflation and longer term?
I mean, I think my view is we want to see workers enjoy higher wages. I mean, that's absolutely true. The labor share of income has been declining for 40 years. That's an economic conundrum. I don't think it's a healthy thing. At the same time, we model out what do we think the strikes mean for the U.S. economy or a potential government shutdown for the U.S. economy. Traditionally, these strikes have been shorter-lived, and there's not been a big imprint on the economy as a whole, but it's something that we're watching. It's scenario planning.
But when you see the sort of significant increase that
the problem with the timing of these strikes is it's just, I mean, we're coming off of the obviously the biggest rates of increase of inflation since the 1970s, right? And so it just adds more fuel to the potential fire here.
The result from at least some of these strikes, do you say to yourself that's a good thing because you want higher wages, or do you think that's a bad thing because it's going to make your job that much harder?
Well, it's something that I looked at, especially a year or two ago when inflation first took off. I started paying a lot of attention to union contracts and whether they were adding back in the cost of living adjustments. In the 70s, almost all union contracts had cost of living adjustments built into the contracts because high inflation was so present everywhere. Over the next 20 years, they sort of fell away. Then they started creeping back in. So we do pay attention to these contracts for what they mean about the future of inflation and whether or not inflation expectations are getting embedded in the economy or not.
Interesting. Okay, so let's get into this next clip here with Neil Kashkari. Hear what he has to say.
It looks like the dual mandate, one side of it is totally under control. So it gives you freedom to go after inflation because the job market has stayed so strong. So I would say, so you would say that the risk is that inflation is not conquered at this point. But I think you need always in the back of your mind to realize that if we don't need to cause a recession, there's no reason to be responsible for one and stay too long, stay tight for too long. Don't forget, even though it seems like the unemployment is not, you're not worried about it, you could be worried about it very quickly and you could stay too long and you don't have a crystal ball.
I appreciate those thoughts, Joe, because you are 100% right. Yeah, 1 minute you're worried about inflation and pay increases, and next year you're worried about job losses and cutting rates to zero. I love that.
And, you know, just like you didn't know inflation.
Things change fast. I mean, the Fed wasn't even concerned about inflation at the beginning of 21. By the end of 21, all of a sudden everybody started talking about inflation. Whoa, what's going on here? Oh, man, maybe this isn't coming down, right? And no one was even worried about the Fed having to, I mean, Wall Street, to give you guys perspective on this, I don't know how many people know this, okay? But going into 2022, Wall Street thought that, and this is Wall Street as a whole, thought that the Fed would likely end 2022 at a Fed funds rate of somewhere between, it was like 0.5% and 1%, okay? Obviously, where we ended the year was, I think we ended the year close to 5% or around 5% for Fed funds rate by the end of 2022. What a difference. So this just goes to show you how fast things can change in like just even a 12-month span. Where, so, all of a sudden 1 minute you're worried about this, and then all of a sudden it's like, whoa, now we got a way bigger other worry. And next thing you know, you're printing money. Next thing you know, debt's climbing to all new ultra high levels. And you're wondering, did we accomplish anything, or did we put ourselves even in a worse situation?
Was going to be stayed at zero. That's the criticism for too long. You could stay tight longer than you need to, and suddenly the soft landing is a fantasy that didn't happen.
So these are the exact debates that we are all having with each other. I can speak for my colleagues. We all want to avoid a hard landing. 100% of us want to bring inflation back down to 2%, and we want to preserve a strong job market. And we're all very happy with the progress that we have made and how robust the job market has been. But we also know we need to complete the job. And so we have to go all the way there. And hopefully we've done enough, but we just don't know right now.
There's been a measurable change in the tone and the reality, I think, of what's been happening with higher rates and their impact on the economy. Every day, it seems like in the Wall Street Journal, in the lead position is some impact of higher rates on the real economy. Story today about rollover of debt. Yesterday about how it's beginning to bite and hit people. And I want to really pick up on Joe's question. Are you satisfied? Was it the intention of the Federal Reserve last week to give a much more hawkish message that resulted in additional tightening of financial conditions in terms of higher long-term yields? Is that what you guys want right now? Or are you beginning to do you have any concern at all that you have gone too far, that steak is going from medium rare to well done?
Yeah. Well, I don't think that it was anybody was making a decision to say, I want to try to tighten financial conditions using the summary of economic projections. That is a collection of 19 individual forecasts, for lack of a better word, or projections of optimal policy. And you look at the data, look at this. In June, the SEP had around a 1% real GDP for 2023. In September, the median was now 2.1. That is a monster revision in 3 months. The economy has been much stronger than any of us appreciated. One would think the policy is going to respond to that.
I could argue back with you, Neil, that the essential mistake you made in that forecast there was that GDP doubled and inflation came down more than you expected. So you got the result you wanted without having to bring GDP down to 1%. Why not let it ride? Instead, you're trying to quash the economy and create a recession.
Well, we're certainly not trying to quash the economy or create a recession. Some of that progress has been energy prices, which, as we discussed, are volatile. Core has been stickier. Services has been quite sticky. And the fact that by some measures, housing is ticking up again. I know you mentioned, Becky, that it's supply. No question. But there's also demand matching that supply. Gives me reason to be paused.
I mean, there's a lot of pent-up demand.
There's a lot of pent-up demand.
And rents are going up. And by the way, everything you do to try and fix inflation makes housing more expensive, which makes rents go higher because you can charge more for rent when people can't afford to buy. It's a crazy cyclical thing that just catches people who happen to be in a position to have to move right now.
Yeah. We nonetheless have a job to do to get inflation back down to our target. And if we simply said, well, there are all these factors and let's just call it good, then all of a sudden we said 2% and now it's 3%. And that absolutely undermines the credibility of the Federal Reserve.
So you have to take a much higher level perspective on all of these.
The credibility of the Federal Reserve, sir, you just said you don't even know if you're at the right rates. Like, what are we talking about here?
Things. There's going to be problems that pop up all over.
Don't worry about the credibility. Like, come on, man. Come on. Transitory, we all remember that. Come on.
That you don't love, but you have to live with to keep your eye on the bigger ball, which is making sure inflation doesn't get out of control. We had an investor here earlier this morning, Mel Lagomasino, and she cited what you have been saying, what you wrote, as a reason that
I hated that answer Neil Kashkari just gave there, or if that was even an answer. Becky Quick just kind of pushed him a little bit on, well, everything you guys are doing is actually making housing more expensive. Bottom line, the Fed keeps raising rates. It makes it more expensive. At the end of the day, home prices haven't come down that much. No one wants to sell their homes because everybody's locked in at 3% rates. So you have very tight supply, right? There's always going to be some sort of demand out there. Heck, even in the great financial crisis, there's some sort of demand. So there's always going to be some sort of demand. And then those people are getting screwed. Rents can go higher because then you can't produce as many homes because not as many people can afford the homes because interest rates, if you're going to get a mortgage, are like 7.5%. So we have the most unaffordable housing market we've ever seen pretty much in the United States history. You know, and a huge part of the reason why it's like that is because of the Federal Reserve. And it just seemed like he just kind of like bypassed that and, we're trying to get inflation down. Like, come on.
A recession is coming. She's like, listen to what Kashkari says. She's really worried that a recession is coming because of what you've been saying. Is that the intended effect that you have, that you wanted to have by saying these things, that you think we're going to have to keep rates higher for longer?
Well, it's a funny thing. If we have to keep rates higher for longer, it's because the economic fundamentals are even stronger than I appreciate, and the flywheel is spinning. It isn't obvious to me that that means that a recession is more likely. It just might mean that we need a higher rate path to get inflation back down to 2%. Again,
why couldn't it be normalizing from the rates where they should be?
Fed is not trying to cause a recession. You could say right on the flip side, a couple of years ago, Fed is not trying to cause high inflation, but you still caused it, right? So you might not be trying to cause a recession, but you're still going to cause a recession, right?
Finally, I've heard people say that. You go back to the great financial crisis. What were yields the years before that leading up?
Wait a minute. I've never seen this. Is this all security because Neil Kashkari's in the building? Whoa. That's insane because they never have like security there. It's just people doing funny faces and stuff back here and like looking in. Wow, this looks like all security. They got to protect the man. That's interesting. I've never ever seen that for any important person they've ever had on. I've never seen all security lined up there. That's interesting.
Financial crisis about where they are now. So maybe we're here.
Even like they'll have billionaires in here all the time, talking and never see security. But man, for this guy, they got the whole security squad out there. Man, that's crazy.
We're here. Maybe the next move is a little higher, maybe a little lower, but we're here permanently, and we've lived with rates. And you're never cutting. What if you don't cut in the next 5 years? Is that possible?
If the neutral rate has gone up, because what determines the neutral rate? It's the balance between the supply and demand of investment capital. Demand, investors and savers meeting, that sets the neutral rate. So if there's big demand for investment capital in America, that's a good thing.
Good, and it should cost money to get capital.
It costs money for high NPV projects. So if that was one of, hey, there's strong economic growth and a lot of investment, and that causes the neutral rate to go higher, that's a good reason.
So, Neil, what's your best guess at where the funds rate is this time next year?
And who are the biggest hawks and biggest doves? Who do you argue with about?
Well, I'll tell you this. My seatmate, for a variety of reasons, I have assigned seats next to Austin Goolsbee.
You do?
Yeah, so Austin and I have become good buddies.
Is it alphabetical or is it based on
I'm not sure.
geography?
When I got here, I've got the St. Louis Fed, so Jim Bullard next to me.
It could be.
Have you been arguing with Austin lately? More than normal? Have you called him an ignorant? No. Okay.
Austin's a good guy.
So tell us where you think the funds rate will be.
I had in my SCP projection the funds rate basically holding flat next year.
Flat.
Basically saying go up one more tick.
Doesn't that mean if inflation comes down that you're going to be tighter and more restrictive next year?
Yes, it does.
Why?
If in that scenario, we will all look at that, and if it makes sense to dial back a little bit to keep the restrictiveness constant, we can do that. But you're having to write something down. You're having to pencil in a forecast with a lot of economic uncertainty. You can't play out every different scenario and say this is exactly how it's going to play. You got to write something down.
How shocked would you be if you guys orchestrate a perfect soft landing, like Nadia Comaneci or something? Would you? Is it? I mean, you just say it's too good to be true. Do you think it's too good to be true?
I would have said it's too good to be true a year from now. Over the last 9 months to a year, things have really moved in our direction, which I'm feeling better about. But
you know what? That would be non-consensus because no one believes you can do it. So maybe you will.
All right, folks. Let me know if you guys think they can pull it off. I appreciate everybody joining me as always. Thank you so much for being here, folks. Thanks for being subscribed. Neil Kashkari is the scariest man in the stock market right now. And very, very interesting. So appreciate you guys. If you want to support my content, support me on Patreon. There'll be a pinned comment down there. And you also get to see the moves I make into my Fidelity account in the Patreon squad each and every week. Much love and have a great day.